you want to go ahead and start?
Oh, hi. Lots of signings today, payroll funding, redraw docs, you know how it is. So thanks for coming. These people are my favorite. And what's so great about them is if you take a client to one of them, such as Kelley or something, and she can't do it, she knows everybody else's own programs. So your client will be taken care of no matter what. Enjoy.
Yeah. They were actually all, I think several of you came in early and you guys all, and I heard you all talking about stuff you had going on your desk. We also have Amy Gena, and Amy, you want to step in and,
hello everyone, thank you so much for coming. Amy Glennon. I'm the area manager here for Western, for Lane County and Douglas County, and I get to work with these two every day. So thank you so much for coming.
And just so I don't forget, at the end of the class, next week we have a class in Cottage Grove. Actually, as you might have not heard, we are opening a Cottage Grove office here soon, I believe, and it'll be announced soon. However, next week we are teaching a class that's probate and civil estates. I see dead people, taught by Tanya Silky and Jackie Center. That'll be at the Brew Station next Thursday at 2 o'clock. We're 1 CE, so if you're out in Cottage Grove, Crestwell, that area, please come join us. It's kind of a less informal class. It's kind of fun. Everybody interacts. We held one last month. And then the first week in December, I have a flyer over there. We are offering a farm deferral class, and that's another one that Tanya Silky pulled together for us. And it's made up of 4 experts from the county to talk about farm deferral, and it's going to be a great class. 10 a.m. and that will be via Zoom because the 4 experts from the county are going to be from different areas, so they're going to all Zoom in, and so you can join that class via Zoom.
It's really important for you guys to understand that because it has potential tax liability on the future owners. So it's really a great class for you to really understand. I hate it when I'm doing a closing and somebody says, no, I don't want it in farm deferral, and the client has to pay like $7,000. It's yucky.
And then we have another class we'll be announcing soon in January as well. So if you are not receiving our invites, maybe someone else shared today's class with you, or you saw it at a tour or an event, let me know. We'll make sure those emails are getting to you. You will be receiving your CE credit in your inbox today, maybe actually during this class from myself. And then I'm going to go ahead and turn it over to our panel. I want to start off with each of you introducing yourself. Talking anything you want about where you're from and what you do, and then we'll turn over to Tanya to lead the panel.
Okay. Gena, you want to go first? Sure. My name is Gena Edgar. I'm with WaFd in Eugene. I've been with WaFd for well over 12 years now. Managed for about 10 years and did loans, and now I get to strictly focus on making home loans, retail loans. We're a portfolio lender, so I like to share that. We don't sell our loans, we're really proud of that. We build our relationships, so it's really important to us because we're going to actually have those for 30 years. I have 2 kids. I live in Eugene. I'm getting ready to move out to Crestwell, and it's really exciting. But I'll still work with them.
Hi, my name is Katie Hansen. I am with AgWest Farm Credit, formerly Northwest Farm Credit, some of you might know. I have been with them for 18 years, almost 19, crazy. So I've been in the Eugene market since 2010. I've known a lot of faces in here that I've worked with before. Specifically, we focus on rural financing, purchase, refi, construction, bare land. So anything that's outside of city limits, that's kind of the realm where I live. Funny enough, I grew up on a farm. I went to Oregon State University with a Gen Ag degree. I've got 2 kids who live out in Elmira. We have 20 chickens and 2 dogs, and we really kind of embrace the country lifestyle. It's a lot of work. So I try to prepare people who say, I'm going from town to 60 acres. Do you know what you're getting into? Because it's a lot, right? So yeah, I really enjoy it. There's a lot of different things that we do at AgWest that are unique, and we are like Gena, we are portfolio lenders, so we keep everything in-house.
Randy Tergesen, U.S. Bank Home Mortgage. I've been with Home Mortgage at U.S. Bank for 11 years now. We specialize in residential lending, construction lending. We do portfolio lending as well as conforming and government lending. U.S. Bank possibly will sell your loans, but we service all mortgages, so our customers will always be able to walk in and talk to somebody about a mortgage. I've been born and raised here. I work locally downtown. If you have questions, give me.
Kelley, Fifarek, Banner Bank. I have been with Banner for 15 years, going on 16 years. Construction lending, we also, actually each and every one of us also does lot loans, so that leads our clients to a construction loan later. We are also a portfolio lender, but we also sell to the secondary market, Fannie Mae and Freddie Mac. So we have a number of investors, which allows for a various difference in interest rates so that we can do different types of financing, especially unique financing. So we do unique structures, not just manufactured homes or single family. We also do shipping containers and some other types of structures.
My name is Idong, Ekwere, and I'm with Evergreen Home Loans. Most recently here with the last year and a half. Prior to that, I've been with another bank here in town for the last about 18 years or so. I'm typically known for construction lending, so that's most times on my phone calls, that's normally construction related activity. Even though I have a whole plethora of products available to folks that I think a lot of folks benefit from. I'll probably just highlight one, and that's a cash suite of products. Oftentimes you have customers who are in transition that need the ability to buy a home, and we have ways to structure those transactions the way they can navigate that in a way that works well. So, but anyway, lots to offer. Yeah, glad to be here.
Thanks for coming, all of you. So I really want this class to be very interactive. So if you have a question, I want you to raise your hand, interject, because the purpose of a class is we all walk away with something that we didn't know before, right? So construction loans are very special niche, and all of these participants know their stuff. What is the most important thing about a construction loan? Does anyone know? What is the scariest thing for a lender or for a homeowner? Construction liens, right? So a contractor has a right to lien property 75 days after any work is performed. It's pretty scary, right? Especially when you have a contractor that's handling all the subcontractors. So it's really important that your lender and your escrow team knows how the money is being funneled in order to build that house. So all of these programs that we work with is to protect you and your clients. Now, who does manufactured homes? Jen, you want to talk a little bit about your manufactured home?
Sure, I'm working on one right now. We love to do them. They can be a little tricky. We need to work with the manufactured home supplier, make sure what they require in their contract for, say, cash deposits and things like that, or upfront payment, works with what we can do, or if the owners, the buyers, can make that deposit themselves if they have assets to do that. So I like to get that conversation done up front, make sure, can we even work together? Because we know that there's some manufactured home suppliers we can't work with and some that will work with our draw procedures. So I get that taken care of up front. If we can't do it, refer to somebody else who can. But yeah.
I have a question for whoever wants to answer. What are you typically seeing more in this past year? Do you see people who are selling their home to buy and build, or are you seeing just straight out cash buyers?
I'm seeing a mix, but I'm seeing a lot more people who want to be able to keep their home as a rental and have that income in the future. Sometimes they can and sometimes they can't. It depends on their income level, but I'm seeing a lot more of those types of scenarios being requested. And if we can't do it, then they're usually open to selling or something like that. But
Do you
you typically look at the collateral of the rental home as, per se, something of equity?
I have a cross collateral loan, which is kind of like a bridge loan. And we can look at the exit home equity, a portion of it, to apply towards the purchase or construction of a new home. Has to be like properties, so like a primary home, exit home for a new primary home being built or purchased. Could be a rental to a rental, or second home to a second home, but it has to be like properties, but we do.
Is there money, like, if it's a like home, let's say, once it's finished, it would cost more, or it'd be appraised more? Does that still count, or is it only in the process?
For us, it's in the process, so, but we get all of the information we can about the new home that's being built. It's not there yet, but we get plans, contract, material specifications, a cost breakdown, all of that. And the appraiser appraises it as if that home was built today. So it's not reappraised after construction, but it's appraised very thoroughly on that.
So how are you handling that if they wanna convert the home to a rental and there's no rental income history? How are you using any of that other than just looking at just a portion of the equity?
So for us, in that case with our cross collateral loan, the anticipated future use of that home needs to be to sell it. So they need to be anticipating they're gonna sell their exit home or their exit rental home, whatever it is. The nice thing is we don't put a timeline on that. So we don't say you have to do that within 9 months or 12 months. It might take a year, it might take 2 years to sell that house, that's fine. But if they're planning on keeping that exit home as a rental, that's not what our program's designed for. We would not look at that exit home equity. We could look at offsetting the payment with future rental income, but not any more income than that to qualify them, so it just offset the payment basically.
And your bank would consider that?
Yes.
For Banner Bank, we would offset the payment of if you're converting or not, or planning to sell. We'll use 75% of the anticipated rents to offset that mortgage, so you're not being qualified with 2 mortgage payments.
How do you verify that?
Yeah, we will send an appraiser out to do a drive-by, and they will put together a rent schedule for us, and then we take 75% of that amount.
Let me piggyback on that. Are you providing that program on a new construction build, or is that only on a purchase of an existing home?
I can do that on construction.
You can do it on construction. So does that make sense to everyone, what they're talking about? Like, a construction loan takes a period of time to construct the home. So then we're looking at forecasted rental income a year out, right? Because they're still gonna live in the home for the year while the home is being built.
And you truly will have 2 mortgage payments, whether you're
Absolutely.
collecting rent or not. But that is how we offset having 2 mortgage payments from a qualifying standpoint.
Say you're in like a duplex or a multi-family home, would you be able to match what you're currently getting on one side?
Yep.
Okay.
75%, because we'll send the appraiser out. We can utilize full rental, Banner Bank can utilize full rent of the one, because that will be reflected on past tax returns. So we would calculate the income, as standard rental income is calculated, and then the other unit would be looked at by the appraiser.
Okay.
What would you do if the zoning didn't permit 2 houses on the same property?
Then they can't build them.
Wouldn't do it.
So, with the flexibility Eugene and Springfield are showing as far as wanting cottage clusters, there is a gray area between having a single family dwelling that can be 6 feet apart from the next dwelling, but yet it's also considered a duplex or a triplex. Where does that land with you guys? In my case, we have a home that we've purchased that my mom's gonna live in, that's unit 1. There's enough space behind to put 2 or 3 units behind it. We're probably looking at like a land use division scenario. But they're gonna be separate dwellings, but the city of Springfield is calling them a duplex or triplex. So, how is that verbiage, I guess, determined how the loan is structured through any?
If I could answer that, basically, now, not every program is gonna be different.
Sure.
In my realm, if you have a primary residence and you want to build additional units in whatever capacity, I can do up to 4 units on on a construction transaction for primary residence. So if you're adding to existing structure, perhaps what you're talking about, and maybe later on you decide to divide it, which you can, but, with the provision you're talking about, for expansion, primary residences with additional units, I can go up to 4 units.
Before you launch into a commercial loan
Yeah,
type of scenario, right?
That's correct.
Okay.
And then if it's an investment property, I can do construction for, rental that's, single unit or more, or duplex. That's kind of where we cut it off. But the point being that, I'm seeing more and more of those kinds of scenarios where folks are buying property where they have additional land they're looking to add to. And there are solutions for that.
Do you have to be in first lien position?
Yes.
So with that, make sure that you know that if you're sitting at 3.25% rate from several years ago, you're going to have to refinance that loan in order to get the funds for the construction.
That's right.
To build the other structures.
Also, as far as the, whether it's looked at as a single or duplex or triplex or whatever it is, we look at, of course, what the permit says, what the zoning allows for, but really it comes down to how many pieces of land are there and how many living units are on there. So it could be 4 detached structures, but that's a 4-plex because there's 4 living areas. So it's gonna come down to all of those.
All of that.
Yeah.
I think my first question to you would be, how many addresses are there gonna be? If there's 1 address, then it's considered a 1 to 4 unit property.
Okay, yeah, and that's, that kind of, so, we already have the primary residence, the old 1940s houses that was refurbished throughout. And then there's enough space in the back to put a minimum of 3 units. I guess that goes to my next question, which is, we're gonna pay cash for the first one that we're building. And then launch into the second one, we'll probably, refinance or whatever to get the loan for the second purchase. Now, I've been told by a couple of people that have either tried to do this or do this, that the loan amount based off of what would be the second unit, which is the first unit that we're gonna construct, that may be different than like a regular house.
It really comes.
Does that make sense?
Yeah, it really
What I'm
comes
asking
down to, with construction, a lot of these loans are hypothetical value or as will be. So we're using the bids, plans, and specs, and we're giving that to an appraiser to come up with a value of if that home was completed today, what it would be worth.
Okay.
So depending on what that structure looks like for this scenario, they may need that value with the second home there to get to the loan to value and the cash that you would need.
Yeah.
Or another option would be, and I have people that talk about this, is they don't owe a lot on their property, so they'll go get a home equity line of credit from their current lender, use that and be their own general to construct a smaller structure. Then they don't have to refinance the first loan either. Then when they want to, hopefully rates will do something that are advantageous to them, they'll refinance into a fully structured 30-year term.
Right. I just like to piggyback on what Katie said. When homeowners decide to go that route, it's awful for title and escrow. I'm just gonna tell you honestly, because people think they can get a contractor and all of a sudden they can go to Home Depot and buy their stuff and just build things. Well, for title insurance purposes, our goal is to protect the buyer and the lender, right, from construction liens. It's number 4 exception on the title policy. It's our number 1 exception that we're really concerned about. So if you have somebody that's not keeping track of, what they spend on, then I can't deliver title insurance for the buyer. And if your mom's buying a brand new construction house where Joe Blow decides to build this house, I can't protect mom from construction liens. So it's just something.
Yeah,
like that.
and I would agree. That's a lot of coaching from a lender's perspective. Sometimes people that call, and I would agree, most of these guys, all these guys up here do too, is we're talking to them about what that looks like, right? Like, do you have a general, what do you wanna build, what's your estimated budget, is that really enough? Let's talk about that. Contingencies, do you have the cash position if something is more expensive than you expect? What does that look like? Here's how you should track it. Here's a copy of a sample bid sheet you can use that's maybe got AgWest logo on it, but it's a PDF they can utilize. So there's a lot of that goes into it, because we look at it and say, well, hopefully in the future when they need term financing, they'll think of us or come back to us, right? So let's give them the time to figure out how to do this correctly.
Right.
Yeah, and I mean, I can speak from the building material side of it, it's not just the construction lien that comes into play, it's, I don't know how many intents to liens that I had to execute because said builder couldn't pay the bill.
Right, yeah.
And then started robbing Peter to pay
Yeah.
Paul,
Sure.
and then, you know, few homeowners down the road, now they're getting liens against them, they're having to pay double.
Right.
Right.
And like COVID was a crazy time for us. So I have a construction disbursement desk, so I work with a lot of these lenders. And it takes a long time to organize your thoughts, create the plan, create the build. And then, and a year later, guess what? The material prices might have gone up like 15%. So if you have all that information and you have somebody who can help you through the process at the very beginning, it will protect you and not scare you so much. Or you won't be like, oh my God, $20,000 more. I wasn't expecting that.
Well, if you have a client that, you know, is contemplating the idea of building, I think it's just wise to, even if they think they have enough funds to do it, I think it's wise to have them engage with the lender and talk through the process. We have a lot of safeguards when we encounter, you know, transactions that we can sort of predetermine if there are issues and holes and things that, you know, would be problematic. It saves everybody, you know, trouble, just having a simple conversation. So, and it could, you know, also very well be, I mean, we do have provision for owner-builder type scenarios, but there are times when it's probably not in the customer's best interest to do that. You know, it's just best to hire somebody to do it and pay for it and call it good.
Yep. I mean, you definitely wanna, we've developed relationships with contractors all over the place, and you definitely want a contractor that knows what they're doing, who crosses their T's, dots their I's. It's really kinda sad when you have somebody who doesn't know how to scan invoices and.
Well, we all approve, I assume you guys as well, we all approve contractors, so when a contractor comes in to work with a client for a construction loan, they have to go through an approval process with AgWest and likely these lenders too. Kelley, you're crazy. And
We verify 3 credit lines. If they pay their bills, we'll work with them.
okay, so, you know, hopefully they don't have 20,
Yeah.
but at least you know. Most of them have to go through an approval process, so they've gotta have decent credit scores, they've got to pay their subs, they've gotta have some experience in projects, so.
Yeah, every lender has a different bar for that. I know where I came from, it was a little bit more stringent. But sometimes you might have somebody who's been a superintendent for a company for years, you know, they're really the brains behind the operation and they decide to start their own company. Some lenders will not allow that, you know, individual really to be able to, you know, manage a project. Where we would say, hey, you know what, given the extensive history and the fact that they've been responsible, you know, for a lot of those things, you know, we're okay with that, you know, we're willing to take the risk. So not every lender is, you know, on the same page as far as that's concerned, so you just have to, you know, research and find out who might be.
Well, and you're speaking my language, right? I've been in the industry and Amy knows this, I've been in the industry for almost 30 years, right? Ekwere Lumber in Springfield, Chambers Construction as project manager, super, you know, manager of the department there. So I have all that experience. I just made the decision to quit doing it for somebody else and do it for myself.
Yep.
So, you know, what I'm looking for is the ability to be able to, you know, have an explanation letter that explains my experience, put in that resume that says, oh, you know what, this guy has the experience, he just doesn't have the applicable experience of the house itself.
Right.
You know, and has seen 30 years of mistakes that have been made and having to file those intents and things like that, so.
Absolutely.
Exactly, absolutely.
Do you have an owner build program somewhat?
We have an exception process for owner build
Okay.
situation.
You do too.
We do too.
I think we all have an owner build of some sort up here, so.
And so when you say that, you mean they have to have some prior experience?
Have to have experience.
Similar,
Electrician.
to what he was just talking about, his experience, like I had an engineer actually who built his own house, and what happened was he submitted all his bids, I mean, and if anyone's worked with an engineer or is an engineer, they are very detailed and ask a lot of questions, and he goes through things very thoroughly, and his bid we thought was really light, so we required a 25% contingency while he's using it, so, but he's building it, and it's great, and it's working well. So it's just a matter of like explaining yourself.
Exactly.
Yep.
Go ahead.
So if you own the let's say you own some lots and you decided you wanna build on them. Maybe you have some experience, maybe you haven't done it in a while, but you know people who do, you wanna partner up with somebody that has some experience and is a general contractor and done some builds. Would that contractor need to get approved, or would you consider the would you consider the property like equity or basically the collateral, I guess, and make, then the property owner, would they have to subordinate as well as part of that process?
It sounds like investment, which would be not my.
Would you be building for the purpose of selling it? Or? just
It
building-
depends. I think at this point, he probably would wanna sell it, but he's actually changed his mind on it a couple of times already and given him cash and kept him as rentals. So I'm kind of trying to advise him to sell something and kind of, you know, get more.
Does anyone up here have a program where you build stuff?
No.
We are hoping to bring ours back. We have it for existing spec, we call it spec, or speculative sale builds. We're hoping to open that back up. We're starting to open some things up that had kind of closed down, like commercial construction during COVID, things like that. So I'm hoping to bring it back. So I would say, with WaFd Bank, check back with us, hopefully maybe in a year.
Well, you used to.
We used to, but not for a while.
Okay.
Tough environment.
Yes, it is.
There's private money channels, obviously, that a lot of folks can go to, but I'll throw one other item and ask you, because I've dealt with, a developer slash, builder structure with multiple units like that, and, I was able to put together a strategy to finance the end user, with our construction loan. It took a little bit of work to do it, but, I'm always happy to engage in conversation if there's something I can do to help facilitate something like that.
Probably the most important piece is just having conversations with someone you can trust. Okay, let's kind of back up a little bit. Now, all of you do your construction loan process a little bit different.
Yes.
Katie, you wanna talk about beginning to end?
Sure.
Talk about, credit score just a little bit?
Yeah, so at AgWest, we are a more conservative lender, so just by saying that, I would tell you our minimum credit score is 700, my max debt to income ratio is gonna be 36%, where some of these guys up here are making me cringe at 50, freaks me out a little bit for people, but, they're only eating top ramen, so the way that works, no, they have great products, it's just, I've been doing this too long in this area that it's very conservative when it comes to, credit standards. Start at the beginning, application just like a residential purchase. They have a contractor, or depending on what that scenario is, then it's bid, specs, and plans. Property's appraised at 50, home is complete, we will lend up to 80% of that hypothetical value. So the cool thing about our product is we close up front, so we close before the house is built, we close with Tanya at Western. The interest rate is locked based on the interest rate today. So for instance, I get to brag about my interest rates today because they're better than all these guys' interest rates. That's what we were talking about. It's a less riskier loan, and it's a 30-year term loan, and it's only fixed for the first 15 years, 6.75% fully prepayable. So no prepayment penalties on that. 30-year term, only the first 15 are locked though, okay? So the whole piece of that is that within that 15 years, they need to do something with it, they can refi, they can do whatever they want with it. Or they reprice it in 15 years. But that loan, so we closed it in escrow. Now at this point, we take the package and it goes to our construction closer in Spokane, because we're portfolio, keep it all in-house. Draws are dispersed from there once a month for a year. Interest-only payments during the course of construction. House is finished within the 12-month period. Regardless of the day of completion, say it's 9 months, you're still making interest-only payments until the 12-month mark. At 12 months, it will automatically convert to your principal and interest payment for the remainder of those 14 years that are fixed. You're done. There's no interest rate change, there's no refinance, there's no conversion, there's no fees, it's all done up front. So it's really nice for the customer to be able to just be like, okay, I'm building my house, and in 12 months, I know this is my payment that I need to make. Because every month it'll be a new billing cycle because it's interest only on what's dispersed.
So no modification, no refinance, straight.
Yep.
Okay. Maybe you wanna talk about yours?
Yeah, so, US Bank has an all-in-one construction loan program, 30-year fixed mortgage, no prepayment penalties. The construction draw period is 12 months, 15 months, rate is locked in, at closing, and remains the same throughout the course of construction and the life of the loan, 30 years. The construction, payment during our draw period is interest only, based on the principal, outstanding at the time the bill is issued. The process starts, it's pretty straightforward. We need plans, we need a builder, we need cost estimates. We'll credit and income qualify you right out of the gates. Then we loan up to 80% of the cost of construction or the appraised value, whichever is less. Credit score, we go to 680, is the cutoff. Then we go to 45% on our debt to income ratio. Let's see, I talked about buildings being approved.
What's the determining factor for 12 or 24 months?
It's
building scenario?
the builder and the
Square
borrower.
footage?
No, it's the
Size of
builder
home?
and the borrower determine how much time they need to build the house. So you've got some projects that are larger than others,
Yep.
and because of that, they may need more time.
Can I ask a question about the debt to income ratios for all y'all? Is that the finished product debt to income ratio, not the current where they're living?
Correct.
Correct.
So like we talked about those rent payments that we were just chatting about earlier, like, for instance, that's gonna be their permanent financing payment, their current mortgage if they have one, or potentially offsetting rent payments, so. A lot of people that are calling right now saying, I don't wanna live in an RV on the property, I wanna keep my house, so how do I do that?
And how do they do that?
So it
Will you
depends on
say
their
that?
finances, right? I have a lot of people that live in RVs too on their property, so, it really depends. Scenarios.
I'm sorry, I missed what you said, how they do that.
It just depends on their financial scenario,
And their
if they
affordability,
have
right?
the ability to afford the payment.
Of both the
Yeah.
current loan and the interest only during that.
Well, their current mortgage and their new proposed principal interest payment at the
Oh.
end of the interest
So
portion.
they have to have.
They have to be able to qualify for both those payments.
At those debt to income.
At the- yep.
Oh, yeah, that's tough.
And also, I like to talk to people, it's same for us, when we
Yeah.
look at bill payments. So there's what we can qualify them for, but also, what are they comfortable paying?
Exactly.
We might have our calculation and assume they have, 56% left over for other things, but maybe they are paying for college and 6 car payments, I don't know. They might not be able to afford it themselves personally, according to what they wanna spend their money on.
Yeah.
So there's 2 ways to look at that, what can we qualify them for, but also, what are they comfortable paying for? Do they wanna make 2 payments, can they? Would they have to give up something else, or maybe, sell a car or something? How willing are they to be able to pay both mortgages?
I hate to beat this horse, but, so it almost sounds like for people that are gonna have a less high income, it might be best if they're renting now, and then they'll only have one payment after the bill.
Yeah, I mean, I have people that will sell their house and move into a rental during the course of construction, and that rental payment is not used against them in their calculation because it's short term, right? Once their house is done, they're moving into their new home, and that's their payment.
Can you also talk about, I think you started on the whole manufactured home?
Yeah, I was gonna circle back.
Okay, thank you, I like that circle.
Why don't we do that after? Because the programs are so completely different, but they overlap, so it's really important for you to understand the process.
Okay. So at the close of escrow, the client will enter a 12-month construction phase. We go up to 15 months, but we also offer extensions. Extensions do come with a cost. The cost is dependent on how much is remaining in their escrow account, and then you take an equation. So, in theory, the amount of an extension should be pretty minimal because your home should be pretty much built by the time you're requesting that extension. A lot of the times, the extension fees are less for the client to pay rather than paying for a 15-year construction term up front. So when the loan closes, the client's gonna pay interest-only payments through the course of construction. The first interest-only payment is calculated off half the loan amount. Then as they start to take disbursements, that payment is going to increase similar to a line of credit. At the time of completion, Banner Bank's gonna modify the loan, so we're gonna transition out of the interest-only payments into fixed principal and interest payments at that time. We're also gonna offer a float down interest rate if you're in conforming loan limit. So if you're not in a jumbo loan, we're gonna float the interest rate down to what market rates are as if it was a standard purchase transaction. So we're no longer in a construction interest rate, they're fixed for 30 years at that point. We also offer 15-year financing. As far as the approved lenders go, like we said earlier, Banner Bank does not have approved builders. We do verify 3 credit references. We make sure that we have their license, that they don't owe any money to the state. When we do the disbursements, we use a system called Built, and I believe you guys use Built as well. It's a web-based platform where the client can request inspections, loan draws, and the individual building the home really stays in tune. So Banner Bank disperses money to the client, not the builder. That's why we feel like, well, our philosophy is that we don't scrutinize the builder because the money is channeled through the client. Prior to each disbursement, we're gonna require an inspection. So that's basically telling Banner Bank, yes, we spent the money on what we were supposed to spend it on within this given month. Then we will issue funds for the next month's draw.
I got a question for you on that though.
Yeah.
On your interest rate, you're locking on a construction loan rate, and if you get to the end of that, is your rate float down if rates are higher? Can they stay in the current rate that they're at for the 30 years?
That's correct. There's a security blanket there.
Okay.
Yeah.
I mean, I hope that that's not the case, but.
Yeah. We'll never float the rate above.
Well, I just didn't know if that conversion is like a short-term product where you have to get out of it, and now you're just kind of stuck.
Yeah. There could be consequences if you're, in a 3-year build, because rates could be.
Oh, yeah, who knows?
Yeah, who knows? That's we don't need that though.
So we have a lot of similarities on our product. We require 20% equity on a construction product. That can come from the land. If you own the land free and clear, or you just have a lot equity, that might cover all of your 20% towards construction or a portion of it, so you might need to bring in some cash. We could go down to 680 for our lowest credit score. We do review the builder package pretty thoroughly. We call it accepting the builder. We don't really take on the liability of saying, your builder's approved. Yeah, this is a great builder. We want you to choose your builder that you're comfortable with, what they have to meet some requirements for us. So we check client references, we call substance suppliers, make sure they're paying their bill, make sure they have existing relationships with those substance suppliers. We used to pull a credit report. We don't do that anymore for our builders, but we do recommend, and we check as well the Construction Contractors Board website, make sure they're in good standing. If they have anything negative on there, we want to make sure the clients know about it, and we'll ask the builder for an explanation. Check the Secretary of State website, make sure they're registered there, so it's a legal business. Get their license, bonded, insurance. So we really do vet the builder, and we make sure that the borrowers know that it's their choice to use that builder. And
Can I ask a question? What's your contingency?
on any project, the minimum is 5%.
Okay, so you're 5%.
Yeah, if it's a fixed price contract. If it's a cost plus contract, we require at least 10% contingency because we know it's very likely that the costs are going to increase. And then if it's owner builder, if we can approve it as owner builder, that's a 15% contingency.
I'm a 10% contingency. What's yours? You're 10?
Less than 20% down, we require 5% contingency, and then if they have more than 20% down, we don't require. So our max loan to value is 95%. 680 credit score up to 95, but if you have less than or more than 20% down, we're 680. 45% debt to income ratio. No overlays for overbuilders.
So in the cost estimate part of it, when the builder is gonna present, because I'll always present a cost estimate, right? If I factor in my own contingency into that, you guys.
We will honor you.
Yeah,
You'll honor
yeah, as
the
long
builders.
as,
You want double contingency.
We'll add no. It'll just depend, we're case by case, once we look at it.
We'll follow you.
No, contingency is huge.
Yeah.
So I'll always have one in.
Yeah, absolutely.
Yeah, okay.
And on owner builder, one more thing, we want our budget, even if it's owner builder, even if you might do some of the work yourself, we want a full budget for any third party to come in and do that work. We've seen everything from someone who just decided they didn't want to pour that driveway themselves after all, or they got injured and they couldn't, they had to hire someone. So it's, the money's gonna be there, whether you need to use it or not, that depends on the scenario.
So with owner builder, I like to say upfront is not when you see the savings.
Yeah.
But the end of the project, when you have money left over that you didn't need to pay somebody with,
Yeah.
that's when you see your savings as owner builder. But upfront, we really wanna make sure there's enough for someone to come in and build this house to make sure it gets completed if something were to happen to the owner builder.
You all like to also see schedules.
As far as how construction's
Construction
gonna go.
schedule, how that goes.
I just don't want a half-built house at the end.
Yeah.
Like, I don't think any of us do, and that's why it feels like a lot to people in the beginning with these numbers, because we need them to understand the risk that's there with this type of loan and what potentially could happen. Because it's nothing better at the end of construction, you get 50 grand back, right, on your principal balance, or you get it back in your pocket, but you have that comfort knowing that that's there, so.
I have a question. So I think, were you talking about like phases, like coinciding when it's like phase one, we have to come in and check and make sure that they're kind of right on schedule?
Well, you know you're gonna either get, as the builder, you're gonna get your progress payments, you're gonna bill out for your progress as you go through to your owner or to your investor, whatever that's gonna be. What I like to include, and this is just from my commercial experience and whatever else, is I will put a schedule of the build together. I know it's gonna take this long to pour my foundations, I know it's gonna take this long to frame my building, and then those progress payments will be wrapped into that certain portion of that build.
So you guys have phases in which you have to come out and inspect?
Yes.
Say,
Yes.
then we're
Yes.
gonna release this.
Yes.
How many
Every
phases?
draw is gonna require an inspection for any lender, so.
And we'll get an inspection every month, even if you don't draw, because we wanna make sure progress is progress.
Or we don't give you money.
Contractors will
Yeah.
submit the
Right.
draw and say, I've done excavation, I purchased this, I've done this, and so the inspector will come out and saying, yes, you did that, no, you didn't do that. Yes, you did that, I will give you this dollar amount, and in return, we want a notarized lien waiver.
Well, that pretty much eliminates the builder taking your client's cash and using it on another building.
Exactly right.
Yeah.
Exactly right. And I use a rule of thumb is, I'll try to align that with my city inspection. Because they have to fall before your foundation is poured, before you panel over and sheetrock inside your rough framing, right? All of that has to take place. So if you think about trying to align that with your city inspections as the progress payments as well, and modify that, you will hopefully inevitably keep yourself in line, but also keep your progress payments in line for your owner and or your investors. That's the kind of rule of thumb that I like to use, and what I always saw as successful from the builders that were successful and not successful.
Well,
And then borrowing Peter.
Yeah,
Peter paper.
yeah.
on Randy's drawings, the homeowner has to also.
Yes, so does
Yeah,
us.
so do they're all, yeah.
If you're taking draws out and you're doing the work yourself, are you able to pay yourself and your team with those draws, or?
It's in the bid.
Okay.
Yep, so it's like go ahead, it's like that.
For us, if it's owner builder, we don't allow, we would call it sweat equity, and I did it myself, I wanna pay myself, we don't allow that.
Okay.
But if you have an invoice, if you had someone come help you and they invoiced you, as long as you're
Okay.
paying an invoice, we can draw money for it.
Okay.
But not to yourself, you can't make money on billing.
On your own.
Yeah, okay.
So
that
think
makes
about
sense.
it in the sense, like, when we look at owner builders, we're wanting to know what a complete house is gonna be, right, what the cost is, and if you can't do the sheetrock yourself, you have an invoice for it, but you or a bid, you end up doing it yourself, and now you have a sheetrock allocation of $10,000, and it really only cost you $5,000. Now you have an excess of $5,000 you can use towards something else in the bid to complete,
Okay.
or you can, potentially take the full, depending on where you're at in construction.
Okay.
So those funds, and I think I can speak for everybody, kind of move after those items are complete. So I can't say, well, this isn't done, but I wanna take 10,000 from framing and put it on my countertop. No, your countertops aren't done yet, your framing ain't done yet, right? So let's get framing done, figure out what that cost is, that excess can then move to something forward if, okay.
It's a little
That
bit
makes sense.
fluid.
So there's a little bit of wiggle room with all of us in how we do that.
Go ahead.
I think this may be totally different, but I'm just confused. I think it was Gena who said cross collateral loan for like property.
Yeah.
Can that be done? Let's say somebody has 600 equity in the home they live in now, and they wanna build a house while still living in that home. But someone else confused me with and so would that still be their home loan plus the principal payment?
So, yeah, so they would keep their current home that they're living in for now, while they're buying or building a new house. So they have 2 home loans. They need to keep making both payments. But depending on the scenario, we're looking at, well, they're probably gonna sell that exit home and won't have that payment anymore in the future, so that.
But they would have to do 2 full payments the entire time they were building.
Yeah, on construction though, they'd be, incrementally increasing as they draw funds out, but yes, we would be looking at what are both full payments, do they qualify for both full payments?
And are they comfortable, and if not, they need a game plan.
Yeah. Well, when you say cross-collateralization, that's a little bit different because cross-collateralization is typically with commercial loans, not residential. Meaning we take both houses and secure lien on both houses, right? The new one and the current one. I don't have that type of product in my residential portfolio, do you guys? So Jenna is the only one that.
Am I talking about like a bridge loan?
It's like kind of, yeah.
Yeah, I like to describe it as all the best pieces of a bridge loan and, not the ones that were scary, like the timeline. We don't make you sell it in a year. If the market changes, like.
Going into it, like I said, what you anticipate doing needs to be that you're gonna sell that house. My goal is to sell that house and move into this one when it's done. If your goal is to keep that house, that's not for this program, but if you're anticipating selling it, that's the plan.
It's a way to, actually, it's a way to utilize your equity.
Yeah.
Correct me if I'm wrong, the thought process is you're thinking the ability to utilize part of the equity as leverage
Yeah.
to build, correct?
Yes.
Yeah, and that can be accomplished, doesn't necessarily have to be a cross-collateral
And the
type
idea would
loan.
be to sell that house.
You
and
can
move
sell
right
it.
into the new one.
Absolutely, that's
Yeah.
one thing you can do, or if there's capacity in terms of what you qualify for, then the option would be to leverage what you have there in some form, could be an equity or whatever, and as long as that satisfies what we need for the construction loan to build, then you can still execute it as long as you're comfortable with the bottom line.
Yep.
So that'll basically manifest in the numbers and, conversations.
And a lot of times people will prefer to do a home equity line of credit or something to get cash out and help.
Yeah.
But maybe you can't qualify for both payments. Maybe you can't have your primary, a HELOC and a new loan, right? Maybe that's too much and you just don't qualify. With our cross collateral, we're looking at upfront and after sale of the home. So upfront, maybe your debt to income ratio is 55, 60. Like that's normally too high, right? But we know once you build your house, you're gonna sell that home, pay down our principal balance, and then what's your debt to income ratio gonna be at that point? That's when we need it to be 43% or less. So we'll look at both. So you could potentially start with the debt to income ratio that's normally too high, but after you sell your house, we know it's gonna be down to where we need it. So that's the benefit of the cross collateral
And
for
do
us.
they do appraisal for that?
We do an appraisal or at least evaluation on both properties. On the exit home, sometimes we can just do what's called like a streamline valuation or something that's faster, less expensive. Sometimes depending on the property, both properties need a full appraisal, just depends on the property.
Do you wanna touch?
Sure, I'll just kind of touch on our process a little bit. I'd like to say, I think for a lot of real estate agents and folks that I'm engaged with, for your clients specifically, it's certainly the most important part, I think, is just the initial structure of the transaction. If they're looking to buy property, obviously, that sometimes can take some time to develop, but, oftentimes, we don't even get to the construction phase until we've tried to figure out the land situation. And so having an option for lot loan, is a nice thing to have. There's some creativity around, even, owner financing, depending on the situation. I've engaged with, real estate agents in the past where, if a seller's open to the idea, we could leverage that. So again, there's so many different ways to structure things, and so it's just a matter of looking at the specific scenario and trying to figure out, what needs to happen. But as far as products for us, we've got, we're talking about manufacturing homes. I have a USDA construction program that will do 100% financing. Not always easy to qualify for because of the thresholds and the restrictions and some of the things, but for the right person, it could be a good option. And then the other thing that we also have that's nice is the ability to approve 100% financing, 100% of the loan to cost, as assuming we have an appraisal that will accommodate it. So basically, as long as if you think about the cost, the true cost of building a home, true cost of land, if our appraised value is favorable enough to exceed that, we have some, we've got a product that, will accommodate, some things along those lines. So, but, from the start, really engaging the client, making sure that they're, we know what their limitations are. That's a starting point, and that's where, if there's a potential pain point, I'm gonna be trying to engage with you as their agent and say, hey, here's what I see, here's what I think, needs to happen. Give you a realistic idea as to what to expect going into the transaction. But ultimately, once the property is secured, once the transaction is secured, then we essentially should have a pretty good map of what the following parts would look like as it relates to the construction loan and the process. So whether it's jumbo loan, whether it's conforming loan, of course, conforming loan I think is up this year. It's gonna be up to about 800,000, which probably covers a lot of the transactions that we do in this area. And so and that fits into the agency criteria, which is nice. In that realm, I think somebody mentioned that earlier, you do have the flexibility of getting the 30-year agency type financing, much like what Kelley was mentioning earlier. We fix the rate in advance, but the client has the benefit of a float down at the end of the transaction if the market is better than what they might have locked in originally. So
Do you do that with a modification?
yes,
Okay.
yeah. So
It's a lot cheaper than a refinance.
$75.
yeah.
It's really
Not bad.
So,
Instead of having to do a whole new.
yeah. So for the right transaction, certainly it can make it a lot less expensive for the borrower, which is nice. We manage all of our processes in-house, so which was critical for me as far as a place to be. It gives me the ability to have access, as opposed to just putting together a transaction and then, it's somebody else handling it. I like to know what's going on during the construction process and whatnot, because there's things that do matter in the early stages that, might need to be revisited perhaps, midway through and then of course to the end. So having the ability to have access is for me, I think most everybody here is the same way, is a big deal, but, yeah.
Awesome, thank you. You all do lot loans, right?
Yes.
Is it 20%?
Mine's
We're all
30.
really different.
Yeah, we are different.
We are different, yeah.
So mine's 30% down on a lot loan, and I need to have power at the lot boundary, a water source, so if it needs a well, it needs to be underwater.
Close on it. The septic can be placed in the future, I just need septic approval or sewer hookups, something like that. So it needs to be buildable and not in a flood zone.
20% down, no improvements required, just has to be rural.
20% down with improvements, 30% without. 30-year amortized.
Yeah, that's a big one.
Oh, yeah.
I'm only 20.
25% down, we do not need utilities, but we need evidence that utilities can be installed, so not with permits, but letter from a local well driller or a perk test. If they don't want to furnish, then we require 35% down. We are a 15-year term on our lot loan.
Yeah, similar requirements for us, just with 30% down.
Okay, and all do manufactured homes?
Yes.
Yep.
Brand new.
New, let's see, new manufactured.
I can do new, I can do purchase of new, construction of new, and I can do a second move.
In construction.
In construction.
Okay.
Second move, really?
We
Yeah.
make exceptions on
These
second.
two.
Okay. That's a big one.
That's a big one. That's new. That's new.
Yeah,
Put it out.
but
That's a big
it's
one.
important to note that the original placement is one. So
Second move just means from the original placement, one more time.
Not the
From-
lot.
from the lot.
Not the lot, yeah.
Right, or the lot. So
from the
from the supplier to the lot, the first time it's built, that's one thing.
And then one more after that.
So if it's in a park and they buy it, and they wanna put it on property, you can't do it.
I can if it's only, if that's just a second.
So that's the third move.
Dealer.
Because it was at the dealer. Yeah.
Second.
Okay, so not from the dealer to my lot,
To your
when I
house,
buy it,
okay.
first time that's
One move.
And then
If I wanna move out to
a different property and I wanna take my house with me, that's the second.
Okay,
That's just my.
I'm just making sure, I was thinking,
Yeah.
okay, because, yeah, these are your go-tos for that.
We will not do an owner builder on it.
Twice move. No, we'll finance twice move, just not construction, but we'll do new manufactured, double wide or greater, no single wide,
And you have a year.
you have a year.
80
Ours is 10-80-10.
Yep.
To disperse. The biggest thing about construction, manufactured homes that people need to realize is that when it's delivered, you don't move in, okay? So a lot of people think, oh, it's delivered, I can move in. No, it's usually 30 to 45 days after it's delivered, it has to be married. That's where you hear the marriage lines. House has gotta be put together, it's gotta go through an inspection, it's gotta be set up. And the other piece of that is, you've gotta have somebody that can help you with setup if you're not a contractor or you know people to do it. Part of that process is coming up with a bid for setup, so site prep, excavation, septic or sewer, well, or city water, depending on where the home's going. You've gotta have someone that can help you set it up. A lot of people think, I'm getting a manufactured home, I'll go out there and all that stuff is already done. None of that's included in the manufactured home cost when you go to buy a manufactured home.
The dealer is not your contractor.
The dealer is not your contractor. So one thing to keep in mind, if you're working with your clients that wanna put manufactured homes on their property, they need to have somebody to reach out to that can help estimate what the other costs will be in that process.
Yeah, especially if they wanna build a garage or a
Yeah.
carport or something like that, that doesn't come with the whole.
Do you guys require a block foundation and tie down?
Yes.
No.
I don't require tie downs, but I mean, it's odd to me that someone, yeah, okay.
I mean, it's not going anywhere, it's gonna be detailed.
Yeah.
Very true.
So I've had people require it in the past, we've had to spend like $500 or $1,000 having it retrofitted.
On a new build?
On a manufactured home.
Some programs might require
Yeah.
a tie down, but
Yeah.
if it's conventional type, construction, as long as it's considered permanent foundation,
Yep.
that's really what matters.
And USDA allows for manufactured homes, right?
Ooh, that's
Wow.
good. 100% financing?
Yeah.
Wow. Write that down.
Man.
Yeah.
A standard
That is a good
USDA
one.
loan, you can't purchase a manufactured home, the only time you can is if it's new.
Yeah.
But you
So-
have specific location.
Well, yeah.
Typically, mostly, and they're on the USDA website, you can always look up an
Yeah.
address to see if it qualifies. Normally, it's gonna be anything outside of city limits.
Those are his favorite loans, he loves
Yes.
those.
All day, every day, totally don't.
This is kind of going back, but, do you guys have like an absolute time limit of when construction needs to be finished? Like even if they've done extensions on their draw timeframes?
Ours is 24 months. We have a build term of either 12 or 18, those are the most common. We can do 24 months. We can plan for that up front if it's over $1.5 million loan amount, large project. 24 months is as long as we really wanna go. It's really scary as a lender to have a house that's still not done in 2 years. No idea what the costs are now compared to when you first approved it. No idea if your borrower's income has changed or liabilities have changed. It can be really scary. So, if we're starting with an 18-month term, which is what we usually suggest, we have room for a couple extensions, and if it's still not getting done, there's a problem. We should be addressing that much further than much earlier than 24 months, but that's really when we're not comfortable anymore.
Yeah, I would
Usually your builder.
Say, yeah, I'd say it's a
That's
lot
a
of.
great builder.
Yeah.
The bank is gonna push it complete, yeah, we wanna see it done.
We want it done. Yeah, we don't want the house back.
No.
We don't wanna have to finish building it.
Well, you
Or
gotta
hire
think
an
about, your client, when do they wanna live in their house, right? So like, we finance on a property in Montana, and weather related, depending on parts of that state, that size of project could take 3 years potentially, if it's a very large custom project. We wanna make sure our customer has a lot of cash, we wanna make sure our customer has somewhere to live, so there's a lot of due diligence up front if we know the type of product that we're gonna be exposed to from a risk perspective.
Yeah, that's usually one of the conversations up front.
Yeah.
Project review is how long it's gonna take, so. And, there could be some flexibility just depending on the
Yeah.
circumstance, but for the most part, we like to
Yeah.
kind of keep it on schedule for sure.
Quick question about, existing home going into multifamily. Do you guys do that as a construction loan? How do you look at that?
Up to the 4 units we talked about earlier?
Potentially 2 or 4, whatever.
Yeah. I mean, so if there's already a pre-existing structure that's there and you're just adding to, we just treat it like any other transaction as far as construction transaction. But, you could do up to, usually up to 4 units.
We just look at zoning, I think, and what kind of permit can you get?
Yeah.
As long as the zoning and permit are doable, then.
Does anyone require a permit in file prior to closing?
Yeah.
Okay.
I
We'll
can do
make
it on
an
first
excep-
draw.
We'll make an exception.
I'm first draw too.
Yeah, prior to close, but we'll make an exception, depending on certain,
Or if you have county approval.
Yeah, if we know that there's, it's pending kind of thing, there's certain things that we could, but part of the reason why we try to manage that closely is expectations for completion times are obviously tied to, issuance, so, if there was like a delay in issuing permits, you're not starting for, a number of weeks or months.
Yeah, we don't wanna see you start your construction phase.
And then that ends up, adding on the back, and that's just not as much fun.
We don't want you paying interest only payments for no reason.
Yeah, so we like to manage that a little bit closer, so, but.
Yeah, and I would say I've had projects where somebody has like an old homestead that they wanna remodel, and then they also wanna build a secondary home or farmhouse housing that's a permanent structure, gone through the process, we now have a bid for this house, we now have a bid for a remodel. Could be two different contractors, and then they wanna build a 40 by 60 shop, so we'll include outbuildings as well, and that could be a whole nother contractor, right? That's a large project, but it happens. We're always gonna be first lien position, and we always wanna account for those costs. I think you guys will include outbuildings too in your construction costs. That's something, you'll start to see as people, or ADUs if they're looking at new construction, so.
Yeah, I highly suggest if you wanna build a shop or a detached structure, do it with the original construction loan. Our construction loan, I don't know about your guys' is not meant for coming back a year or two later and just getting a construction loan to build a shop. We don't really
Do it now.
that.
Yeah.
But if you know you want one in the future and you're building a house right now, try to build that in. Let's see if we can get it done all at once. It's easier, it's faster, and you don't have to worry about it later.
Lumber prices. never
Well,
come down.
no.
The other piece of that is from
Never.
and an appraisal perspective too, we're looking at his hypothetical value up front versus shops don't typically carry the value that it
Right.
costs to build, so
Right.
potentially could be looking, if you're just trying to get a home equity, you're not gonna have it there, depending on how leveraged you are.
So I have a selfish question, because I'll never get 5 of you together here at the same time.
Yeah, you never know, we like lunch, we like
So, middle housing, missing the hole in middle housing, are you guys as lenders still finding that there's a hole for people that come in and are only able to qualify for, let's say, 375 or less, and they can't find something that's new or somewhat new, something you're not gonna have to dump $50,000 to $75,000 into to make it yours anyway? Is there still a hole there in this community, in this region for that type of housing to be built?
For construction or just for purchases?
And,
Or either?
Yeah, I mean, I guess it would all go hand in hand from my selfish perspective, that's what I'm hoping, but.
I think it's still challenging. I
Yeah.
don't think it's easy right now for that middle income borrower to qualify. Rates are still high and values are still high, so the combination of those is really challenging for some people. We have a program that came out a couple years ago, that is as little as 1% down, and it has some income and location qualifying factors that we have to look at. It's a product